Hi there, welcome to another live webinar with us from Full Futures. My name is Sri and I'm your facilitator of the day. Today we will be discussing seeking opportunities in a recovering market. And with us in the studio is professional trader and author Daniel Ang, and he will be walking us through how to seek and capture opportunities in the European stock indices, the Eurostoxx 50 and the DAX, amid a backdrop of a recovering market. But first, before we hear the insights from our professional trader, let me hand the reins over to our event partner from Eurex, Ken. If you're all set up and ready to go, I can give you access to say a few words.
Thanks, Sri. Good evening, everyone. Thank you for attending the webinar by Philip Future and Eurex. My name is Kent, Eurex sales lead based in Singapore. I would like to take this opportunity to say a few words on Eurex and our products. Eurex is a leading European derivative exchange based in Frankfurt, Germany, but with offices all over the world. Our benchmark product, let me show you this. Our benchmark product, Eurostoxx 50, is the leading blue chip index for Eurozone. Index cover 50 largest and most liquid company in Eurozone countries. Companies such as Adidas, Allianz, BMW, BNP Paribas, Deutsche Börse, LV, and so on. Eurostoxx 50 future and option are the most heavily traded product at Eurex. Average trading volume is about 1.9 million. As for DAX, the leading German equity index cover 30 largest companies like Siemens, S&P, Deutsche Bank, Volkswagen, and so on. Average daily volume is about 120,000. On 24 November last year, Deutsche Börse announced the expansion of the DAX from 30 to 40 member companies. The expansion will occur in September this year. In December 2018, driven by the client demand, we extended the trading hour of Eurostoxx 50 DAX and mini DAX into the Asian hour as a first phase of having our product available during the clock. The extension of trading hour also included our fixed income product like Boom Bubble Shark, as well as our MSCI future. This means the trading order of a benchmark product is now 21 hours, starting at 8 morning Singapore time. Last year in December, we moved to a phase 2 of our trading hour extension and extended additional products such as 10-year Euro Stock Bank, Stock Euro 600, and VStock Future. Whereby VStock Future is the volatility index of Europe. Still part of phase 2 to cater the global participant, we successfully launched micro future contract for Eurostoxx 50, DAX, and SMI in April this year. The micro contracts are 5 times smaller than mini contracts and 10 times smaller than the regular contract. If you ask me why we trade micro future product provide the exact hedging tool for global investor, small contract size, and low margin requirement. At the same time, currently Eurex is given free market data for the new private investor. And last but not least, Philip Future is also offering the contract at a promotion rate of Euro 150. Once again, thank you everyone for your time. Hope you will enjoy the presentation by Daniel, and over to you, Sri. Thank you.
Yes, you heard it correct from Mr. Ken himself. Philip Futures is offering a very special promotional rate for the wonderful 2 contracts that Ken has shared, the micro Eurostoxx 50 as well as a micro DAX. All right, the price for trading these contracts is just at a promotional rate of Euro 150. Thank you so much, Ken. Members of the audience, I take it that you can hear us loud and clear. I have no questions in the question box with regards to not being able to hear us. At any point in time during the webinar, if you have questions from our main event speaker, Mr. Daniel Ang, just head down to the question box and type your questions in there. And if you have questions for Ken or with regards to the contracts, you can type them in there as well, and Ken will be happy to address them. Okay, so thank you so much, Ken. Let me give sharing rights to our main event, Mr. Daniel Ang himself. Daniel, I'll let you set up right now. In the meantime, let me just give the audience a quick introduction of what you will be covering today. All right, so our speaker, Daniel, will be covering, as you know, seeking opportunities in a recovering market. The market is recovering. How do you seek and capture opportunities in the European stock indices amidst a backdrop of a recovering market? Some countries are experiencing a relapse. As in they're having a surging number of COVID cases. But where are the opportunities? Mr. Daniel Ang will be walking us through what are the equity indices, advantages of equity index futures and trading them. What is the multiplier effect of equity index futures contracts over the years? And this will be some of the key talking points that Daniel will be walking us through today. About the speaker, Daniel has been in the industry for a long time. Almost as long as I have been born in this world. All right. Daniel started his career as a commodity broker back in 1985. Subsequently, he has gone on to have successful stints in Standard Chartered, FIMAT Asia, the brokerage arm of Société Générale, and thereafter at the end of 2006, he became a full-time trader and still is today. Daniel, if you're all set to go, let me hand the reins over to you.
All right, thank you very much, Ken. Can you guys hear me? I hope you can.
Yes, we can, Daniel. Over to you.
First of all, a very good evening to all of you. And we are in the last week of the month of July. Not sure whether you guys have been following the Olympics. This is the 4th day of the Olympics. There are a few surprises. I have not been actively following the Olympics. I'm not much of a sportsman myself. But anyway, we are in the last stretch of the month of July, and we have already seen quite a fair bit this year. Have you ever wondered this bull run that we are seeing, which starts in March of 2009, how much more does it has in terms of the momentum going forward? Is it going to be much higher prices going forward, or are we likely to see some kind of correction in place in the coming future? So this is what we're going to talk about more or less today, but our focus will be on the Eurex micro equity index futures. Like what Ken has been saying, we're going to talk about the DAX, which is the German stock index, as well as the Euro STOXX 50. Now, without much ado, I have to cover this as well. Now, this presentation is definitely not an offer for you to buy or sell anything at all. And trading of derivatives such as futures and options do carry risk, although the reward can be very rewarding as well. Now, all of you should actually consider your own risk profile and your suitability before attempting to trade any leveraged product like a futures or options. Okay, the options are the opinions that you're going to hear throughout these presentations are purely mine and has got nothing to do. And please do not hold me against this if you should take my views into actual trading. So those are things that I would not be liable. Okay, so please be aware that these are just my opinion. Now, when it comes to equity investing, there is always a dilemma because ask any stock investors, what is a good stock, or if the market is going up, or if the market is coming down. You ask any stock investors, and they will be hard pressed to give you a definitive answer as to whether the market is up or down, okay? Because there are so many listed companies in any organized exchange that offers equity trading. Some runs into the tens of thousands, so there is a myriad of different equities in which you can invest in. But all investors face the same problem because our finance is quite finite and our resources is definitely limited, and we have to use our best judgment to be able to invest in the stocks that would possibly give us the return that we are looking for. But because they are so varied in the sense that because there are different sectors, there are growth sectors, and then there are, of course, different companies with different performance. So it does give the average investors some kind of a headache. But if you ask an investor based on the index itself, the general mood of the market, for example, in Singapore, we have the Straits Times Index. You ask any investor where the Straits Times Index is heading, it's very highly likely that he will be able to give an opinion whether he thinks market is up or down. Likewise, in Malaysia, you have the KLCI, same thing, okay? Equity index does give the ordinary folks like you and me a general view of the markets. Instead of trying to trade the individual issues, trading the entire basket of markets, is a lot easier. So this will be the main topic of this evening. Before we go into the Eurex itself and what they have to offer in terms of equity index futures, let me give you a little bit of the history behind STOXX index. Now, STOXX index didn't come around very naturally. Back in the 1900s, you see that people were trading. There are only few stocks that are available for trading in the, I'm talking about US stock market. Back in the 1900s, there are only a few stocks listed in the New York exchanges. So there's this guy who was a journalist. He is not very highly educated, so he was given this job to go to report on financial markets. Okay, so he realized that the definite view of where the market is heading, like what I was mentioning earlier on, which stock is going to be going up better than the other one, because in those days, although there are only a few listed companies, but still the problem is the same, right? So what we want to know is based on the available stocks that we can see. So this guy is called Charles Henry Dow. Okay, he started inputting in and tracking the individual stocks and then come up with an average. So this average, he posted on a company that he found, which is today still surviving. Okay, we're talking about the Wall Street Journal. So he and his other partner, his name is called Charles Henry Dow, and his partner is obviously Edward Jones. So we have Dow and Jones. So the two names are the names for the very famous stock index that we know even up to today, which is the Dow Jones Industrial Average. Okay, so back in the olden days, this is how it started. Started with 12 stocks, out of which 10 are basically railroad companies. You must understand, back in the 1900s, the railroads was the backbone of the economy, very much like the internet of today. Okay, so that's how he gets started. And then over the years, you can see within 2 years after he started in 1984, we have something that's akin to what we call the Dow Jones Transportation Index, because there's he used a moving average, which he posted on the Wall Street itself, the Wall Street Journal, and this was later to become the Transportation Index. Then again, in 1916, you can see the Dow Jones Industrial Average fully come into being. That was the first time the entire index was published back in 1916. Then shortly thereafter, within 1 month after the launch, not even 1 month, I think it's probably about 2 weeks after it launched, there was a recomposition of stocks. They are entirely new index in which they have 20 stocks, 8 of which are the old index from old stock from the old index, plus 12 new stocks that are added into that combine to be called the Dow Jones, the new Dow Jones Industrial Average. Then in 1928, just before the Great Depression, the Dow Jones expanded to 30 stocks. That's why we have the Dow Jones 30 stocks even up to today. Okay, so this is a little bit background of how the stock index evolved over time because of a need for people to have a grasp of the general market rather than the individual shares. Now, all stock market have a natural bias on the upside. Ask any stock investors, most of the conversation will be centered on what to buy, which company to buy. Nobody will be talking about which company to sell. So equity market as a whole has this natural tendency to go up. So we all know this is a very traditional view, okay? And this is going to be something that we're going to be talking a little bit more as we go forward. Because the market have a natural tendency to go up, we must also understand that no market goes up continuously without coming down. There will be times the market do come off. So when the market does come off, investors are faced with so much restriction in terms of selling forward. You can sell what you already bought, but you cannot sell what you don't have. So that is what we call selling short. So because equity investors always have this dilemma, and over the years we can see that exchanges and regulators will want to prohibit or even outright ban the activity of short selling a stock that you don't own. These days you can do it, you know, in Singapore, for example, you can sell short for maybe 5 business days before you need to buy back. You know, there is such facilities, but even those are very limited in scope because you are only given 5 days in which to buy back your equities after you have short selling the listed company itself. So back in 1918, at the height of the market crash, back in 1928, where the Great Depression happened in the States. Remember, in those days, the world is not globalized yet. So what happens in America stays in America. Okay, so back in 1928, the market crashed, and the SEC, which is the U.S. Security and Exchange Commission, actually outright banned the short selling altogether. Okay, then again, as we move into the 20th century, the SEC decided to do away with this particular outright ban. Okay, then shortly thereafter, less than 3 years thereafter, they reinstate back the short selling ban again. But this time they do it with a little bit of a tweak. You know, they allow the market to come off by X percentage. In this case, it was 10%. Compared to the last closing price, if the market falls by 10% or go up by 10%, based on the last closing price, the market will go into a what you call a circuit breaker. Okay, in our term, we will call it limit down or limit up. That means 10% compared to the last closing price, the market dropped 10%, it will go limit down and then it will stay there. And it means no selling will be allowed, but you can buy. Likewise, if the market goes up by 10% relative to the last closing price of the day before, the market goes into a limit up situation in which you cannot buy anymore, but you can sell. But limit up is so rare in equity markets, but limit down is what we are going to be more concerned about. Okay, so during the 2008-2009 global financial crisis, not only the US again banned the short selling activity, a lot of jurisdictions also banned outright the short selling. Then again in 2011, during the European debt crisis, in which we have Greece and we have Cyprus that was like at the verge of going under, that again the Eurozone also banned short selling. At the start of last year, again the activity like short selling was also banned when the market suddenly came down very aggressively when the WHO announced the COVID-19 as a global pandemic. So you can see selling is always very difficult. So how to overcome this? Because we all know market do come off, and when they come off, the law of gravity is the same as in any activity that we do, because in financial markets, the law of gravity also applies. Just like Isaac Newton have an apple that fall on his head 334 years ago. Today, what goes up do come down. We are still ruled by the law of gravity. And in particularly, I like to emphasize this. It may take the market years to go up. For example, the current bull market that we are seeing right now is already 148 months, okay? Meaning to say it's 12 months, 12 years and 4 months in the running. And we have just seen last weekend, you know, it has gone again. The Dow Jones is at record high, the Nasdaq is at a record high, and the S&P is at record high. So how much more does it has in terms of momentum going forward? What we are more concerned is what if, when this market is going to peak, you know, when we already know last year during a brief 4 to 5 weeks, the market come off, and that was the most aggressive sell-off in the history of equity trading. So what we are more concerned is the downside, not the upside, because we already know the condition has been laid for market to go up. What happened in 2008, 2009 laid the framework in which central bank massively flooded the market with a lot of liquidity, and all this liquidity went into risk assets, essentially back into equity markets, and that is the fuel, okay, that caused this market to continue to touch new high. And then this year again, at the start of the year, the new president comes in, Biden say, I'm going to do this, I'm going to do that, and then he started to write checks in the trillions of dollars. That provided another round of liquidity that added fuel to the fire that allows the bull market to continue to run, okay? So we are more concerned about the downside. Like I said, you know, is there a way for us to protect the downside? What I do find out was when I started my career back in 1985, shortly thereafter, within 2 years after I got into this business, in those days I took this as a job. But after the life-changing event in October 1987, that changes my outlook for this business. In October 1987, there was a worldwide contagion in which it started in Asia, specifically started in Hong Kong. This market went limit down, and it stayed limit down for 5 business days. And that to me was revealing, because luckily I was short selling the Hang Seng in the hours before the market went limit down. So I actually was one of the very few to catch the entire fall in the stock market crash back in 1987. So that experience changed my life, and I know the power of a falling market, because it may take the market years to go up, but it takes the market only a fraction of the time to come down just as fast. So if you miss the bull run, do not worry. If you miss a bull run, there is always a more efficient way to make the money on the downside. That's what I'm trying to impress upon you. So remember, equity index futures was introduced back in 1982. The first index that was introduced was actually the S&P 500. That was introduced back in 1982. I entered the business in 1985. 1985 was also a very historic year, because that year the G5, which was comprised of West Germany, UK, France, I think it's Spain, Switzerland, no, Switzerland and Japan. Those were the G5 then. They had this Plaza Accord that changes the direction of the entire financial markets, from which Japan never, even up to today, have not recovered. So that was momentum, okay? So I always feel that these equity markets, when they launched an index futures back in 1982, it was so opportune, because shortly thereafter, like I said, back in 1987, there was this big crash 2 years after I entered the business. And like I said, it is a game changer for me, okay? So index futures started off 40 years ago, and it has proven to be one of the most successful product ever launched by a futures exchange. Now, just as then, it is still the case. Eurex has launched a micro equity index futures for DAX as well as for the Euro stock, and it is already seeing results. They only launched it in April, but the volume that they have garnered so far has been very impressive. I'm not surprised, because equity index futures has always been a very natural product for investors like you and me that we can relate to, okay? So now, what can you do with an equity index futures? Of course, you can hedge it. Like I say, we are always worried about the downside. As we bought the physical share, we can enjoy the upside potential. But what we are more concerned is what if. What if the market has peaked and then we bought at high prices, or let's say even we bought at low prices and we are not willing to cash out yet because we think that this market has a lot more potential. Like I said, over the last 10 years or so, okay, central banks has flooded the market with so much liquidity, and this acts as the fuel that will propel stock market ever higher. Even if we're going to have a significant correction going forward, this bull market is unlikely. It's unlikely to be able to break the back of this bull market. So a lot of people will have this idea: I want to be engaged on the long side as far as equity is concerned, but I do not want to cash out, because if I cash out, I may not be able to buy back at a decent price, for example. So what options do an investor have? Now with a equity index futures, she can actually hedge forward his exposure. It will not be a 100% hedge, but it will be very, very close. For example, okay, if you have a portfolio, let's say of 100,000, I'm talking about dollars here, and you do not want to cash out. If you're holding on to local stocks, of course, you've got to go to the local futures exchange and see if they have a comparable futures, equity index futures that allows you to hedge. In Singapore, we have SIMSKI, okay? In Malaysia, they have the KLCI Composite Index. So those are futures contract that you can use. But when we are looking at equity index, these days, nobody, I mean, more and more people are looking beyond our immediate environment. The biggest market are all outside of our region. Singapore is a very, very domestic market, okay? Malaysia, as big as it is relative to Singapore, is still a very domestic market. So we all have to look beyond our shore because the actions are definitely not here. Used to be, it still is, okay? If you're trading equity, US is the place to go because the liquidity is so deep, okay? And the price movement is a lot more volatile than our local equity index, okay? So a lot of people are looking beyond our shores. So when you look beyond our shores, you want to be able to hedge those risks as well, okay? In the event you can, if you see a market you think is about to peak, you want to be able to short sell the equity index, or if your skill is or your knowledge is sufficient, you can actually buy put options, okay? Options has also been very popular, but there is another category altogether which involve a little bit of technical know-how, okay? So this is how you can actually hedge against a falling market or a risk of a falling market. Now the micro index that the Eurex has actually is very ideal because the multiplier is 1. So whatever the index is, that index is the value, is the notional value of the micro index, okay? Whether it is a DAX or whether it is the Euro stocks. So that makes it a lot easier to have an idea how much is the notional value. That means what is the theoretical value of that one futures or the one futures contract in micro that you buy or sell. That's easy to calculate. So you can use that to extrapolate to your actual portfolio holdings. So that is a very straightforward way, okay? Now, obviously, if you do want to hedge, then you can actually outright trade the position. Now, I'm not an equity trader. I started my career as a futures commodity broker. So I started off knowing futures before I even know equities. And because futures allows me to make money on both sides of the swing. In a market that is bullish, I can buy the index or the futures. I can enjoy the upside. Likewise, if I'm bearish, I can sell the futures contract forwards. So futures has always been, to me, more advantageous than investing in a market that only has upside bias, like the equity market. In the equity market, when the market falls, if you don't have a futures contract and you cannot short sell, that means to say in a falling market, nobody makes money, essentially, okay? So when you have a futures contract based on equity, then you have these options to buy on the way up, to sell on the way down. So you can actually trade the index all by itself without even touching any stocks. So that is the beauty for me. And since then, since in the late 1990s, when I started to trade US equity index futures, which is the S&P 500, I'm hooked. In fact, before that, back in 1987, I'm really hooked because the Hang Seng Index was so liquid, and it is still liquid. Okay, the point I'm trying to make is that you can actually use the equity index futures to outright trade the market if you have a view. Okay, do not have to actually be involved with the pain or the what you call the technical know-how, or actually be able to understand company statements and what's the PE ratios and all those stuff. You don't even have to do that. If you have a view, you can use the equity index futures to take the position. Okay. Now, earlier on we talked about the multiplier effect. Why this is important? Why at this stage does does Eurex actually launch the micro equity index? If you look back at the value of this value, I'm talking about the notional value. If you look at the notional value of, let's say, the DAX 30, this chart you can see here in the dark blue area, covering from 1988 back to 2015, you can see that the chart has been going up. So basically, the notional value has been going. The first Euro STOXX, okay, for example, was introduced back in 1998. So that was a very long time ago. The value started at 1,000. Today, the same Euro stock is at almost 16,000. We have not hit 16,000 yet. We are more like 15,500. So you can see from 1,000 to 16,000, there's an increase of the value of the stock market as far as the Euro stock is concerned by 16 times over. So obviously, if we have an equity index back then, okay, that futures contract is worth a lot more now. Okay. Likewise, in the DAX 30, the multiplier is 25, meaning at the current level, the notional value of the DAX is at 400,000 euro. Nobody can afford to buy and sell one futures contract if the notional value is so high. Okay. So in 2015, Eurex actually launched a mini DAX which have a multiplier of 5. That was good because it served the purpose then, and that is the area in the lighter bluish area. You can see in the on the right side of the chart. That was when they launched the mini equity index, and even then the market has already gone up so much. The DAX from by March of this year, the DAX already surged past 15,000. The notional value of the mini DAX that they launched back in 2015 now is worth $75,000 euros, 75,000 euro. So that is a lot of money to buy and sell, even if you have a futures contract. So the notional value is big. So it means this product is getting out of the reach of the common investor like you and me. So this year in April 19, Eurex again, considering the fact that the equity index is becoming quite unaffordable, decided to launch the micro index. In this case, they launched the micro DAX and the micro Euro STOXX. So now the multiplier is kept simple at 1. So now you can see at nearly 16,000 in the DAX, you can see that the notional value now is at 16,000. Now, of course, we don't have to put up 16,000 to buy and sell one futures contract. One of the key reasons why futures contract is so popular over the years is because there is this thing called margin. For a fraction of the notional value, you can buy or sell one contract of micro, and that becomes very affordable. How affordable it is? Last we have an update. You can see that this is the contract spec of the equity index launched by Eurex as far as the Euro stock and the DAX is concerned. Now we look at Euro stock 50. At the bottom of the table, you can see initial margin is 356 euro. Don't you think that is very affordable compared to when the notional value is at 75,000 euros? A lot of people cannot afford it. Okay. So what it means here is that now the initial margin to buy and sell one micro equity index become within reach of you and me. Likewise, for the DAX, is priced a little bit higher. The initial margin is priced at 1,446. Of course, these are not cast in stone, depending on the volatility. Okay, this margin required do change from time to time, especially if the in cases where the volatility actually heightened. Okay, so the exchange reserves the right to actually, to protect all investors and brokerages and the exchange from time to time they do adjust, the margin required to buy and sell a single lot of the micro. So this is quite friendly in a sense because it is accessible. So you can use it for hedging, you can use it for outright position. Of course, for the time being, the options on these two particular contract is it is just beginning. So we will just talk on the futures first for the time being. Okay. Now it gives you an idea where the market is heading. These are my views. You can see this is based on the DAX, which is the weekly time frame. This is based on the September contract. Now I must understand that both the Eurex, the Euro stocks, as well as the DAX, they all have a quarterly calendar month contract, meaning to say the current contract that is actively being traded is the September contract. Okay, and once the September contract almost comes to an end, you either roll over your position or you will have to close out the position and take up a new position in the next contract, which is the December contract. Okay, so this is based on the weekly time frame for the September DAX futures. Based on last Friday closing, it was at 15,530. For the week itself, it was down marginally at 123 points. You can see that for the year, it is up almost 13%, which is very, very good. Okay, so will this momentum carry forward? That will be the key question that we have to ask ourselves. Now, when you look at a market, you have to decide how you're going to approach the analysis of the market. Some will prefer to look at it from the fundamental point of view. Now, fundamentals are great because those are the reason why the market moved the way they did. Okay, but from a trading perspective, for a trader, fundamentals do not necessarily work out very well because we cannot time our entries. There is no mechanism for in fundamental analysis for timing our entries. So most will use some kind of technical analysis for that purpose. For the last decade or so, price action trading has also come into very popular, and people were starting to use also price action. Meaning to say they don't use indicators, they look at a price and they will make the decision based on that. You can see this chart has no indicators. So I belong to the last group whereby I will look at price, because whether the fundamentals is favorable or not favorable, it will be reflected in the price. Okay, at the end of the day, the price will be the ultimate barometer of all these things that comes into being, whether it is technical or whether it's fundamental. So look at the price, for me, has worked very well. So based on this, I'm not going to go down into the strategy and how I come up with this analysis. All I can tell you, there is a dominant trend. Now, in any market, there are two basic trends. You must have a dominant trend, a trend that sets the pace, that sets the directional bias on the market. That is called a dominant trend. If the dominant trend is up, obviously you want to buy. The question is, where do you buy? Okay, at this current level, almost near the high, do you want to be buying? If you buy at this current level, what are your upside objectives? What if the market come off instead of go up? Where do you want to protect yourself? So all these questions you must ask. Okay, so you need to have a view. So right now in this presentation, I'm showing you my view of the DAX. This is the weekly time frame, and I have a target at 18,159. Where the market is right now, we still have a good at least 2,000 over points left. Okay, but whether it's going to go up there in one straight go or it will struggle all the way there, obviously it's not clear. Okay, but I do have a target. This is what we call my medium term, my long term target. Okay, now when you have a view, there must come to a point whereby if the market consistently comes off and not go up instead, at what point would you change your view? To me, I will only change my view on a weekly time frame if the market go down and take out 11,312. So that is very far from where we are right now, but it is not impossible. And also based on this analysis, there's currently no counter trend. There is a dominant trend and there's always a counter trend. Some people trade counter trend, some people like to trade a dominant trend. Okay, so it all depends because we all have different ideas and we have different risk appetite. So some people like to trade counter trend. So those are good, but you must know if the market has a counter trend to begin with. Okay, so this is the weekly time frame. So on the daily itself, we can see that the market has more actions. You can see that the movements are a lot more jagged. So on the daily itself, based on yesterday's closing price of 15,000, almost 600. In fact, yesterday's closing price for Monday is only 1 point. It is quite ridiculous, okay, because market has not moved a lot, okay. Of course, there are fundamental reasons why the market on the close-to-close basis go back to where it opens, okay. For the day itself, from yesterday's closing, it was down 54 points, down only about 0.34%. Again, for the year itself, you can see that the market has actually gone up 13%. So on the what we call the daily time frame, it is also bullish. It has a dominant trend which is bullish in sync with the weekly time frame, and the target I have is a lot lower, below 18,000, at 17,837. So these are again not cast in stone. Sometimes the market can drop short, sometimes the market can overshoot, okay, but it gives me a target for me to measure, if I want to take a position, what is my upside potential. You need to have a target, because then you can measure the risk reward. If you do not have a target, then it's very difficult for you to justify the trade. Everything must boil down to numbers. You got to have the basic numbers intact, okay, relative to the potential reward. What is the potential risk like? Okay, some people say is that for every dollar I put in, I have upside potential of $1, but I also have downside potential of $1. Is it going to be worth my risk? Okay, so again, it is very personal. Everybody has different kind of approach, so you have to see. On the daily time frame, you can see that there is a counter trend. So that this counter trend is actually coming down. You can see from the extreme right side of the chart, the market have a sharp dip and then it pulls back up. And that sharp dip was yesterday. Yesterday, there was a news that was released as far as Germany. DAX is a German index anyway. So any kind of German economic release or statistic release will definitely have impact on DAX. So if you are trading Euro equity index, make sure you are aware of the timing as well as what is going to be released, your expectation versus what it was previously. So all this, you just have to expand what you do for US equities. Okay, if you have been trading the S&P 500 or the Nasdaq, whatever you do to trade those markets, you will have to do it for the European equity index. Just that we all have to get used to new statistics, names and titles that we are probably not very familiar with, but that is okay because it's the same thing. Okay, economic statistic will impact the performance of the equity index itself. Okay, so we have a counter trend on the daily time frame, and there is also a target at just under 15,000. And when I would think this counter trend will be over if the market goes beyond 15,806. So it's very specific up to the last tick itself. Okay, so that must be how you approach this. Now on the Euro stock itself, the Euro stock, you can also see roughly the same thing, but when you compare the weekly, early on, if you can remember how the weekly chart looks on the DAX, and now you compare it to the Euro stock, you'll find that the Euro stock is not as bullish. Okay, so it is no surprise. Within the Eurozone itself, the biggest economy, the strongest economy is Germany. So the German equity index is more bullish relative to an index that is made up of French, the other member states listed companies, as well as a sprinkle of German stocks. You can find that on balance it will not be as bullish as DAX. So here lies an opportunity for you. Let's say, for example, your technical know-how is more advanced. You can do something what we call spread. You can sell the Euro stocks, you can buy the DAX. Okay, so you are not necessarily looking for the outright up or down. You are only looking for whether the spread between the two index narrows or widens over time. Okay, so that can be a strategy you can use without taking excessive risk, because if the market goes up, one side will be making more than the other one. Okay, likewise, if the market comes down, one side will also benefit relative to the other index that you do in a spread contract, in a spread kind of a strategy. So you're not doing the outright, you're just doing the relative value between two assets. In this case will be the Euro stocks as well versus the DAX. In the weekly time frame, it is bullish. Okay, I have a target at 4,689. Likewise, if the market falls below 2,890, then my view will have to change. That means to say that the dominant trend is no longer bullish. I will have to flip to the bearish side and trade accordingly. Similarly, on the weekly time frame, there is no counter trend in place. Okay, none whatsoever. However, on the daily, you can see it's very similar to the DAX. We already have a sequence of down. Okay, today we have a sharp rebound in the afternoon. As this chart is good up to the afternoon. You can see, based on this chart, you can see the market still has a rebound. Based on the last closing price yesterday, the market was 4,099. Okay, only 1 point. Okay, so in percentage terms, there's hardly any movement. Year to date, you can see the Euro stock is up 15 on the absolute basis. Yes, it is. Yes, gained more relative to the DAX. But if you see over the longer term, the performance of these two index, DAX definitely has shown more to the upside. In the daily time frame, you can see the market is generally bullish. There's a short-term target at 4,510. Downside is at 2,884, meaning to say if market goes below this price point, then I will no longer be bullish on at least on the daily time frame. The counter trend is bearish. It means to say that if the market dominant trend is up, the counter trend is always the opposite. The counter trend have a target of 4,119, and if the market surge above, I think I have a counter trend target. Okay, I think it is upside down. Okay, the counter trend target is at 3,849. The invalidation is at 4,119. I'm sorry about that. Okay, so you can see the reason why the market comes off on Monday, because they released this particular information called the Germany IFO Business Climax Index. So again, we will have to get ourselves familiar with new statistics, because if you are trading euros product, you have to know what are the major statistics that will be released. The market was expecting a 102.1, expecting a much better number, which is the portion with an orange tip. However, the market release was below expectation, was only 100.8. That means to say that the business climate is not as bullish. Despite the reopening of the economy, businesses are not as bullish. Okay, so that caused the DAX and the Euro stock to come off yesterday. Okay, so you must understand all this. Okay, so the next key event that we will have to watch very closely is this year German election, which is likely to be held, not confirmed yet, it's likely to be held on September 26th. And this will be key because the current Chancellor of Germany, Angela Merkel, has been in power for quite long, and she already said that after this election she's going to retire. So this one event, the election, the outcome of this election is going to change Europe for the next few years. Okay, because under Angela Merkel, the Eurozone has been more or less very stable. Okay, once she leaves, we will have to get used to the new leader who's going to replace her, and everybody within the Eurozone will have to readjust their position relative to whoever is getting elected. If they get a surprise candidate, very much like Donald Trump, you know, who was not expected to win, but he did, and then that could change the dynamics of the entire Eurozone. So do watch out for this particular event. It's quite far away from now, at least 2 months away from here. Okay, so we will have time to prepare for this. Now, if you want to know more about the micro equity index that Eurex offers, there's a ton of resources available on their website. These are what you are seeing here is resources you can find from their website. Okay, there is they also have broadcasts. They also have video clips that you can also watch that explain to you what are the micro futures and what are the pro and cons. You know, there's a lot of stuff. There's also a webcast which you can also tap on to when they invite analysts to talk about in-depth analysis. Okay, so if you have any question, this is a time to post your question. So we have some time, so please do start your questions.
right. Thank you, Daniel, for the insightful presentation. Dear audience, this is a great chance to ask an experienced trader for his views on the market and anything pertaining to the European indices. In the question box, let me see. Looks like we have 3 questions on hand at the moment. The first one is, has China and Hang Seng Index, has the bull run ended for the Chinese and Hang Seng Index?
The short answer is yes. One of the things that I do is I do keep track of quite a wide range of products, including equity index, and I'm not necessarily only looking at US equities, although that would be the mainstay. But to have a global view, you do need to have keep track of all the other indices. However, having said that, the granddaddy of all equity index is still the main driver, because you see, US market is the last market to close every day. So whatever closing price they decide, all other markets, when they reopen the following business day, is a reaction to what the US has done the previous business day. So Asia is the same thing. What closes in New York, when Asia opens up, you will react accordingly. If it's down the previous night, and then obviously the next morning when Asia open up, you will follow through. And then Europe will take the cue from Asia. If Asia continues to fall by the time Europe market opens, then you will also open on a weak note. Okay. However, again, if it started on a weak note, by the time it gets into US trading hours, US market tends to have the ability to flip the sentiments upside down. Okay. For example, yesterday the market was down basically throughout Asia, throughout European trading hours. But when US market opens, and by the time it closed, the market has recovered all the losses. Okay, so again, you want to have a global view. Yes, the short answer to that question, whether Chinese equities and Hong Kong index has already ended the bull run, to me, the medium term, yes. The long term, yes. Mean to say, daily time frame has already shown me that it is over. Weekly time frame has already shown me it's over. In fact, between Hang Seng and the Chinese equities are a lot weaker.
All right, on to our next question. I think if you're new to these German indices, one of the questions in your head will be, are dividends paid on these indices when you trade?
No, they are not. The one thing about equity index futures is there's no dividend payout, because you see, we are trading a derivative of a derivative. An equity index is a measurement of a basket of shares. Okay, so you're not actually buying or selling any shares at all. So there's no question of dividends. So when you have a futures contract that based on a stock index, it is a derivative of a derivative. So there's never been any questions of dividends.
All right, on to our next question. This is from CK. He's asking, based on your charts which you had shown earlier, what is bullish and bearish invalidation?
Okay, very simple. Remember earlier on, I say, assuming I just cover one first. In any market, there's always a dominant trend. So the dominant trend is, for example, in this case, is up, is bullish. Okay, so we know the market has a tendency, it's more likely to go up than come down. So that is the dominant trend, but it has a tendency to rise. So when you have a dominant trend, you must also know when, at what price in the market consistently to go opposite direction, it hit what price point before I have to change my view. Because a bull market do not stay bull market forever. At some point, it will turn into a bear market. Okay, so we have to understand at what price point, that point in which the market once penetrated, I will have to change my view of the dominant trend. And then within this dominant trend, there's always a counter trend. Counter trend is like if the market is bullish, as it corrects, that correction is considered as a counter trend. For the counter trend, we also must know at what point if the market goes back to where it was, in sync with the dominant trend, at what price point, if it goes beyond that price point, the counter trend is considered invalidated. Okay, that means to say the bull market is back, the bullishness has resumed. Okay, so whether it is counter trend or dominant trend, you need to have invalidation point. So this is what I mean.
All right. Next question is from CK as well. He's asking why weekly and daily short-term target is different.
Oh yes, you can see if you, let's say for example, if you are a scalper, obviously you may not think that the weekly or the daily is important, but you cannot be further from the truth. Even if you are a day trader, you still must take your cue from a higher time frame. Remember, a higher time frame more controls the lower time frame. The lower you go down in terms of the time frame, okay, the more noises you're going to get. Yes, you're going to get a lot more trading opportunity. That's no doubt about it. However, you must know the dominant trend in the weekly and the daily. For example, both weekly and daily are bullish. If you try to sell within the day itself, you must understand you're trading against the trend. The market has a tendency to go up in a higher time frame, so that sets the tone for the market. So if you want to be safe, then maybe another strategy is, since the market has a tendency to go up because the weekly, the daily dominant trend is up, then maybe I only want to take buy signals and ignore the sell signal. You can use a variation of strategy, for example. But let's say if you are a person with higher risk tolerance and you say, look, I like to trade counter trend, you can do that. But you must understand at what point the counter trend will be considered as invalid, and you have to protect yourself accordingly, because the market dominant trend is up, and if you're trading counter trend, your risk is a lot higher. And how are you going to control the risk? One of the strategies which I use is actually quite common sense. If the market have buy signal, I know that my buy signal on the intraday itself is in sync with the dominant trend with the daily and the weekly time frame. Okay, then I will take a regular size in terms of position position sizing. However, if I trade counter trend, I know I'm going against the market. So maybe for that, I will trade half the size. If I have, each time I do an intraday trade on the buy side, maybe I do 2 lots. And then if I'm doing counter trend, I do 1 lot. That could be the way you can rationalize trading against the market. But however, having said that, all dominant trends started life as a counter trend. But if you're not going to hold position, obviously that is not going to be material. Just know that counter trend begin life as a counter trend before they become a dominant trend. Okay, so let's say for example, in the months going forward, if the market have a big downside move, eventually it invalidates the bullish validation point of the chart. Then you will have to flip your idea that the dominant trend has flipped from bullish to bearish. You can use my system, the way I look at it, across all time frame. Okay, I can use it for the weekly. Obviously, I don't use the weekly time frame for timing. I don't use a day. I can use daily time frame for timing if I'm going to hold position for a few days or a few weeks. Okay. However, for intra-trade trader, obviously you have to go down to the lower time frame and to do your selection. But always bear in mind the higher time frame will exert an influence over the lower time frame. Okay, it's best if you are new to this game to stay with the dominant trend. That means to say you will, for a timing until the sentiment has changed. Okay, you only take buy signals and ignore the sell signals. You may have given up 50% of the opportunity, but that will keep you in the game a bit longer.
All right, thank you, Daniel. Next question is from Muru. He's asking, what's the midterm outlook for the FTSE and France, the French indices, since they're already at an all-time high, and right now they're facing a surge in daily cases of COVID-19?
Yeah, this is the main worry right now. Everybody talk about the reopening, the recovering market. The Achilles heel will be this new variant, or what they call the Delta variant. It appears that from the news report that we have been reading over every day, it seems that the Delta variant is very infectious, and the cases of infection have actually gone up again. So if this persists, there is a risk, okay, of the economy locking down again. And if that happens, that will have a catastrophic impact on equity market, because the market is geared up for reopening. Because right now we're in the middle of summer. We just have the Euro Cup, the European Cup, okay? And then we have a Freedom Day. You can see photos of the British out partying in the street. So if this variant is as infectious as we are told, then going forward over the next few days and weeks, if we see a big surge in infection from places that fully open up, then the risk is that they may have to lock it down again. And if that happens, that will be devastating, because everyone is gearing up to reopen, okay? And one of the reasons why the IFO Business Climate Index actually come out is because the Germans are looking at it and say, look, this is not looking good, okay? And they have become less optimistic. And that was something that we have to watch out for, because the only thing that is going to derail the current bull market for the time being is going to be how bad this resurgence is going to be. All things being equal, of course.
All right, thank you, Daniel. Before we jump into the last question, I just want to take the opportunity to let the audience know that if you have any other questions, we probably can take up 1 to 2 more. In the meantime, for the rest of our lovely audience, if you'd like to know more about the Philip Futures promotion on the Micro Euro STOXX 50 and the Micro DAX, go to your chat box, which is you can find somewhere at the bottom on your control panel. The link to the promotion page is right there. Okay. And now, Daniel, we have one more question from Ken. He's asking, is the US market ending its bull run soon?
From the numbers that we are seeing, we cannot fight the numbers because we just had all-time high in Nasdaq, all-time high in S&P 500, and even the sluggish one, the Dow Jones, just registered an all-time high. Based on this, there is no clear sign that this thing is going to be over soon. But going forward, there is always the risk. Remember, Janet Yellen, which is the current Secretary of Treasury, already warned Congress that they need to lift the debt ceiling or to suspend it altogether by the end of this month. If nothing is done, come August the 1st, the Treasury would have to come out with creative idea how to prolong the debt ceiling without having support. And again, she has been saying that for quite a number of weeks now, and we are already into the last stretch of the month, and there is no news at all that Congress is going to be talking about this. So there is always the risk. And if that is going to be the case, that could be the black swan event that's going to cause the market to come off. So there's a lot of things that can go wrong. You look at the geopolitical outlook, you know, the tension between China, US, and Russia is getting from bad to worse. Okay, anytime if there's a shooting war, all hell will break loose, all bets will be off. Okay, and then you look at the pandemic, you look at the Delta variant, and if this thing resurges, and the knee-jerk reaction is to lock down again, that again will have negative impact on everything else, especially on equities. And of course, we have the domestic politics within the United States between the Republican and the Democrats. They are so divided, they cannot agree on anything other than let's fight China. So the situation is actually not great. The only reason why the bull market is still running is the fact that the liquidity is still there. And because the fuel is still there, the fire continues to burn. But there is that subtle thing that you all have to watch. The Federal Reserve since March, correct, has been doing something what we call the reverse repo. They have been sucking out liquidity from the market. At the rate they are going, we may go into a situation from extreme liquidity in the marketplace to a lack of liquidity. When the market have a lack of liquidity, you will start coming to fall apart. Okay, so that is something you want to watch. Why is the Federal Reserve draining liquidity the way they did? They are massively draining liquidity to the tune of almost $1 trillion a night. Okay, imagine now they are doing QE. Their QE is only $120 billion a month, but they are draining liquidity to the tune, although they are very short term, in the hundreds of billions of dollars for short-term instrument. So something is cooking, and this something is cooking. It is not widely reported, so we all have to keep our ears on the ground and make sure that this thing doesn't become an event. So you have to watch out.
All right, thank you so much, Daniel, for your wonderful insights.
Now, before I go, for those who have other questions you can that you still want to ask me but can't ask me for whatever reason, then you can always reach out to me on Facebook. I can be found at Daniels@Traders Academy /, or you can find me on Facebook. Okay, I have a company. You can reach me out at this. You can see the link at this on this slide itself. Just to let you know that every weekend I do have a webinar. Okay, I call show and tell. I will cover the entire week's happening, and I will talk about everything under the sun, including equity index. I will talk about precious metal, commodities, currencies, cryptocurrency. So it's like I'm trying to cover the entire week activity during this webinar. It's free to attend. All you need to do is just check out my Facebook the link whereby you can log in during my Zoom session. And this happens on every Sunday at 8 p.m. Now, at the end of this month, I'm doing something because to answer the last question that you posed, I do feel that something is cooking, something major is cooking. And I want to do a 3 hours marathon webinar. Again, it is free to attend. I just want to bring this to the public, to let them be aware that there are things that are happening, and they have to make sure that they are aware that these things can happen, and there is a way to protect yourself. If you do not know it, obviously it's going to be very hard for you to prepare. So this 3 hours webinar, which I'm going to do at the end of the month, is going to start from 2 p.m. to 5 p.m. You can register for this. There is a link, but if you have any question, just send me an email at support@tradersacademyonline.com. Okay, so you can again, it is support@tradersacademy.com. No, tradersacademyonline.com. Okay, so you can reach out to me, and or if you do not know, if you need to know more, just follow me on my Facebook. I do post from time to time. All right, thank you, Ken and Sri.
All right, thank you, Daniel. Ken, thank you so much for your summary of the opportunities provided by Eurex earlier.
Right, thank you so much, guys. See you again.
And thank you for being a wonderful audience. If you have more questions for the speaker, just type them into our question box, our survey form at the end of this webinar. And Daniel will be returning in another webinar on 10th of August. Do look out for the webinar in a follow-up email tomorrow and sign up for it. All right, take care, good night, and be safe, everybody.
Okay, bye-bye.
Thank you. Bye.